The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Plan, and today we'll tell you all about investing in the right way. And to talk to us about that, we've got with us Hemant Rustagi joining us in the studios. Hemant, it's always a big debate in the head, right? Lots of ifs and buts when you talk about making investments. Either you're not sure whether you're investing in the right product, or if you're not, you normally don't have enough money or extra money to go out there and invest for the long term. Sometimes you also invest the wrong way. So it's not just about investing in a disciplined manner, but you've also got to be careful about investing for the long term, because that's where the fruit really comes. What is your advice to investors who are looking to invest in the right way?
Well, Samina, first of all, I would say that investors need to realize that investment is not one-time activity, it's a long-term process. So even if you don't have a lump sum money, you don't have to worry. Today it is possible to start investing even with a small sum of money. Fortunately, you have dynamic and interesting options like mutual fund that allow you to start investing even with an amount as low as rupees 500. And the best thing about investing in options like mutual fund is that your money is being managed by professionals. With an amount of rupees 500, you get access to 40, 50 stocks in a fund. And also, if you invest in a hybrid fund, you can invest across asset classes. So I think today it is not important whether you have a lump sum money or not. The key factor in today's time is to start investing early. And the reason for that, especially when we're investing for the long term, and the power of compounding works very well, if you allow your money to grow over a period of time. So I think investors should start as soon as possible, as early as possible.
Okay.
Not worry about whether they have a lump sum money or not. Like I said, there are today options where you can start investing even with a small sum. And another factor where I would like investors to really focus is many a times what has been seen is that even if they start process of investment, they are compromising the long-term goals for the short-term benefits. Now, what I mean by that is many times we've seen, in a high inflation scenario, when the equity markets are not doing very well, what happens is debt options give you fantastic return. So many investors think that let's get out of equity, let's go into debt, let's make some money here, and when the equity markets start doing very well, we go into it. Well, I think that is amount to basically what is market timing. Not every investor can do it. Even the most professional fund managers fail to do that actually consistently. So I think the key factor is, as I mentioned earlier, start the process as early as possible, not to worry too much whether you have a lump sum money or not. Over a period of time, as the income levels go up, try and increase the amount and follow a proper process. You can definitely achieve investment success.
So it's all about investing for the long term and having a balanced portfolio to make or take advantage of market volatility.
Absolutely.
Right. Hemant, we do agree that the investing is one of the most important aspects of financial planning. How important is it to plan your investment process? Because it shouldn't really be an impulsive sort of investment, right? Because that would never yield you good returns, or you'll probably get lost in the way.
Oh, you're absolutely right. It's very, very important for investors to start investment process with proper planning. And the reason for that is that if you do not plan your investment, you don't know how much money has to go into which asset class. So basically what happens is, and that is what we've seen in most of the investors following the process, where whatever comes there, where they start investing. So if somebody says that today equity markets are doing very well, the money goes there. If somebody says the debt market is doing very well, the money goes over there. So I think it's very, very important to plan investment and then start the investment process. There are three simple steps that investors have to follow as far as the investment planning is concerned. One is to establish their personal as well as investment goals. And all of us have different goals. We have goals to be achieved in the short term, medium term, and long term. For example, in the short term, it could be that somebody wants to buy a car. In the medium term, it could be, to provide for children education and marriage. And in the long term, it could be for the retirement planning. So like this, I think the goals have to be established, and then a time horizon has to be assigned. Begin with that. The second thing is very important for investors to realize, to understand as to where he stands in terms of his financial life cycle. Why it is important is because he needs to look at his current situation. That will decide how much money can you invest, in what manner can you invest. You may not have a lump sum money to invest. You may have, money to be invested on a regular basis. So it is very, very important. The third important aspect of the planning is to determine your risk profile. Now there is a simple process as to how you can do it. As I mentioned earlier, once you have defined your goals and you assigned a time horizon, the longer term goals, the more money should go into equity, because you have time. We know that equity market has a tendency to be volatile over short term and medium term. So if you want your equity investment to do well for you, you need to give it time. So you need to have a long term commitment. So long term goals focus should be on equity, for the short-term goals, the focus has to be on debt and debt-oriented options. The reason is that safety of capital is more important. For the long term, what investors need to realize, the bigger risk is inflation. So if you follow this process, what happens is you're always in control of how much money you need for each goal and how you're progressing in that, rather than starting the investment process haphazardly.
Hemant, lack of product information and time is one of the key roadblocks for investors who are looking to make investments and plan their finances, and therefore you have financial planners who will help you through that process. Is it wrong to rely completely on the financial planner to take all your decisions when you're making those investments and tracking those investments?
Well, in today's world, considering that there are so many options which are available, you have traditional options, you have other options like mutual fund investing in the stock market, bonds, debenture. I think it's very, very important to take help from a professional advisor. Even if an investor feels confident, I think it always helps to take help from a professional advisor. And the reason for that is, like I said, you're talking about your hard-earned money and all your dreams which are, have for your family and family members and for yourself are all linked to the money that you're going to be investing. But at the same time, it is very important for investors to realize that even if you have a good financial advisor helping you, you should not rely completely on him. What it does not really mean that you don't allow him to work properly. What it means is that you need to participate actively in the decision-making process. For example, if I have a financial planner, even if he's there to help me out, I know about myself the best in terms of what is my risk profile, what is my attitude toward investment, what is my temperament. Of course, a financial advisor will definitely help me in terms of deciding which way to go. But my role is in defining the parameters, and based on that, a financial planner can work. So I think even if one has a professional advisor, one must participate in the decision-making process. At the end of the day, if you want to become a better and more informed investor over a period of time, you need to start understanding. So you need to participate in the beginning of the process, and also you need to participate when you monitor the portfolio. For example, you may or may not be aware how to monitor the portfolio. For that, you should be asking questions to your financial advisor. That, okay, if you invested in 3 funds on a particular day, why is the performance that differs so much? It could be because these 3 funds are investing in 3 different segments of the market. That is how you start learning the process. So if you by all means, you must have a professional advisor, but also participate. Do not rely completely on others to make investment decisions for you. That's how you can become an informed investor.
And your involvement does not end once those decisions are made. You need to be part of the tracking and monitoring process as well.
Oh, absolutely, absolutely. At the end of the day, as an investor, you know what your goals are. Okay, and a professional advisor obviously will try his best to do, but at the same time, you need to monitor whether his advice is working for you or not.
And how often do you recommend that should be monitored?
Well, I think
you can't do it on daily basis or weekly basis, right?
I would say maybe at least twice a year.
Twice a year is when you should go down and sit down with your financial planner and see what's going on with your investments.
Absolutely. I think it's very important to at least do it twice a year. Like I said, if you ask question to your advisor, he's always on his toes. You know that you're an informed investor. You are an alert investor. So I think that works very well for you in the long run.
Hemant, there's never a free lunch, and we always get caught up in overestimating profits from a given investment that we've made or underestimating risk. You never really think the bad is going to happen to you, right? How crucial is, doing the balancing act in your head where you take enough in terms of what risk is there, or be aware at least of the kind of risk in terms of investing, or of course what you can expect in terms of potential returns, because there's no point overshooting yourself, and that always catches us on the wrong foot.
See, investing is all about balancing the risk and reward. I think it's very, very important for investors to understand what are the risks that are associated with each of the investment they are making. And because if you do not assess the risk, if you do not understand the risk, the chances are that the portfolio may take you beyond your risk-taking capacity, which is obviously not going to be good for health of the portfolio in the long run. Similarly, if you overestimate the return from a particular asset class, and based on that you start working your targets, it's quite likely that at the end of the period you might see a big gap in what you intended to basically achieve and what you actually achieve. So I think both the aspects have to be understood, because every investment option has a risk associated with it. And also, obviously, there is a potential. If you understand what is the risk that you're taking and what is the potential that each asset class is going to be there, or each investment option is going to be there in a portfolio, I think it becomes possible, it becomes easy for you to handle even difficult times. So if you're aware of that, if I'm investing in equity, there are going to be bouts of volatility on the way. And quite likely that in the short term, the asset class may not perform as well as other options. You are mentally prepared to wait out those difficult times. So I think it's very, very important to ensure.
Emotionally, you've got to be in sync as well, because that's where the problem then comes in.
Absolutely.
Hemant, I mean, nobody really likes to take chances with their money, and that's what we said. I mean, it's your hard-earned money that you want to see working for you. And therefore, investors are not very experimental when it comes to trying on new products. And there are so many new products available in the market. We usually stick with traditional products because, I mean, you've got past performance, if nothing else, to gauge the kind of returns you can expect going ahead. Do you recommend investors to go out there and experiment with these new products? Because as time goes by, products as complicated as they might get, they actually might be a better investment vehicle.
Oh, they are. The fact that there are only 3 to 4% of investing population in India invest in dynamic options like mutual fund is clearly testimony of the fact that most of the investors still prefer traditional investment options.
When you say traditional, what do you define as traditional?
I'm basically talking about bank deposit, I'm talking about bonds, I'm talking about debentures. You also have small saving schemes. And I think there are a couple of reasons why investors prefer that. One reason is that these investment options offer guaranteed return, most of them. And I think most investors focus on nominal return. For them, the fact that there is a guaranteed return, they feel very, very comfortable because they don't want to take any risk. But I think it's very important for investors to realize that there are two kinds of risks which are there for every investment. One is the risk to your capital, which is important in the short term to medium term. But in the long run, as we discussed earlier, inflation is a bigger risk. So they need to start focusing on real rate of return, and that is your nominal return minus inflation, minus tax, minus cost. Of course, there is no cost element as far as the traditional options are concerned, but definitely some of these options, even though they give guaranteed return, do not give you tax efficient return. For example, if you look at returns that come from most of the small savings schemes are taxed. So I think it's time for investors to start looking beyond these, because going forward, like I mentioned, especially for the long-term goal, it's going to be very, very important to beat inflation. And the only way you can beat inflation is by looking at asset classes like equity and also more tax-efficient options like even in the debt offered from the mutual fund. So I think the fear there is that because mutual funds do not offer guaranteed return, and also the fact that mostly investors equate mutual fund with equity. Okay, but the fact is today mutual funds offer a variety of schemes in debt as well as gold as well as in equity. Even within equity, you don't have to make your portfolio very aggressive. You have index fund, you have pure large cap funds. So I think there are a whole lot of schemes which are available today, and the time has come for investors to start looking beyond traditional options to make sure.
Especially if you want to invest for the long term.
Absolutely. Otherwise, I think they're going to struggle to achieve their long-term goals. So quite possible that you may continue investing for next 25, 30 years for your retirement. At the end of the day, you will find that you don't have enough to survive your retirement period. So I think it's important to start looking at these options.
What happens when your portfolio is not performing? I mean, it might not perform in the short term, but might perform in the long term. Do you exit these equity mutual fund portfolios, investments that you have, and in a falling market condition, or do you rebalance your portfolio? So when is it that you decide it's time to rebalance, and when is it the time you decide that you need to give your investment enough time?
The right way to start investing is to follow an asset allocation process, and you also assign a time horizon. For example, someone who's investing for his retirement for 15, 20 years away, the first thing is the market volatility which is happening today should not really bother him. Secondly, rebalancing is very, very important. Okay, why it is important is because every portfolio, when we talk about asset allocation, is designed to tackle a particular level of risk. The moment your portfolio drifts in terms of allocation to a particular asset, and it takes you beyond your risk-taking capacity, that is a time to start rebalancing.
Right. That is all about investing the right way, because that is crucial to generate long-term returns. And even, of course, pay your bills for the short term, if that's what you're thinking. We'll take a quick break on that, and we'll come back and then, of course, take up all your financial planning queries, so stay tuned.
Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. We'll now take up all your queries.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query coming from Sultania, who says he wants to invest in a good debt mutual fund where he can get returns of 12% a year approximately. Firstly, tell us if he's overestimating the potential of returns from these debt mutual funds, and whether or not it's a good time to make these investments, and what funds do you recommend?
Well, let me begin by saying that this is definitely a good time to start looking at debt fund. And the reason for that is that, especially within the debt fund, you have a category of income fund which do very well when the interest rate go down. And that is because there is an inverse relationship between bond prices and interest rates. As the interest rates go down, these income funds start doing very well. But I think as an investor, it's very, very important to understand there are different varieties of debt fund which are available. There are ultra short-term funds which are basically essentially meant for those investors who want to park their money for short-term. Maybe the time horizon is 3 to 6 months. Then there are short-term debt funds. If your time horizon is, let's say, 6 months to 12 months or thereabout, you can look at short-term debt fund. And if your time horizon is 18 months to 24 months or even more, that is the time you should be looking at medium-term income fund. As I mentioned earlier, these are the funds which will benefit as and when the interest rates start going down. But at the same time, there are certain risks which are associated with investing in these, because the return here can be a little volatile. For example, if the rate cut doesn't happen for some time, or the rate cut is not as per market expectation, you may not see the kind of rally you're expecting in the debt market. So one must understand and appreciate the kind of risk which are attached to that. But definitely, this is a good time to invest in debt funds. I cannot really say for certain that whether he is going to get a return of 12% or not, because it's very difficult to predict that. But what I generally feel is that the return from these funds is going to be quite healthy, much more than what you can expect from your traditional options. And the fact that mutual funds are more tax efficient, your post-tax returns are going to be much better than what you can get elsewhere.
And what sort of funds do you recommend?
Well, I think a couple of funds that you can look at is basically SBI Income Fund and ICICI Income Opportunity Fund. He can consider one of these funds to start investing.
Well, on that note, we'll take a quick commercial break. We'll come back and continue taking every query, so stay tuned.
The Financial Planner, presented by BSC. Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner. Hemant, we've got a query from Ajay Kumar, and he says he wants to invest 3,000 rupees per month via an SIP in HDFC Top 200, Reliance RSF Equity, and Sundaram Select Focus, and rupees 6,000 via SIPs in HDFC Balanced, ICICI Prudential Discovery, and SBI Gold. He wants to know if there is a need to rebalance his portfolio. This is what his current investments are currently.
Well, I think I would say, Ajay, that you've chosen the right way of investing in equities, because primarily your money is going into equity. You have one investment which is in a gold fund. And the reason why I say SIP is the best way is because, as we know, that equity as an asset class has a tendency to be volatile over a short-term period. For someone who wants to become comfortable with equity as an asset class, the right way is to benefit from averaging, and the best way is to commit a certain amount of money at a predetermined interval, which could be on a monthly basis. So I think you've chosen the right strategy for investing. And also, if the goal is to create a corpus over a longer period of time, that can be achieved with a smaller contribution over a period of time. So your strategy is perfect. As far as the funds are concerned, I think also before that I would like to mention that here, that you must realize that mutual fund by nature are a diversified investment vehicle, which means that even if you invest 2,000 rupees in a mutual fund scheme, you have access to a portfolio of maybe 40, 50 stocks. So it's very, very important to choose the funds properly and have the right mix. Having too many funds, which means can actually result in over-diversification, which is not good for the health of the portfolio. You are investing around 9,000 rupees and you actually have 6 funds in the portfolio, out of which one, as I mentioned earlier, is a gold fund. I believe that you need to reduce the number of funds to maybe 3 to 4 max. I think that is what he should do right now. Fund that you can retain right now is HDFC Top 200, Reliance Regular Saving Equity Fund, and ICICI Discovery, which is a value fund. And in the gold fund, you can continue with the SBI Gold Fund that you have. Which means that if you go by this advice, you will have to realign your portfolio. There are a couple of things I would like you to remember when you realign your portfolio. You need to exit from the fund, the other 2 funds that he has in the portfolio, and reinvest that money into the fund which are being retained now. But 2-3 things remember before you start realigning your portfolio. One is consider the tax implications of it. Now what happens is, because he's investing through SIP, each installment has to complete 1 year for it to become a long-term capital gain. Now there could be that there are certain installments where he has not completed 1 year. If he exits from there, he will have to pay, if there is a gain there, he'll have to pay short-term capital gain at the rate of 15%. So definitely consider that. And most of the equity funds, in fact, all the equity funds have an exit load if you exit within a period of 1 year. So even if you're investing through SIP, there is going to be an exit load. So consider these 2 factors. So which means that if you decide to realign your portfolio, it need not be done tomorrow. You can do it in a phased manner. Consider this. So wherever you have completed 1 year, maybe you can exit from there now and start putting the money into retained fund. For the rest of it, you can wait, because like I said, 15% capital gain tax and exit load may not really make sense to pay at this stage. So I think do it in a gradual manner and then continue with this. Even in future, if you want to invest more money, invest in the same funds. Do not add too many funds in the
Hemant, which ones should he exit and which ones should he stay invested in, the portfolios that he's given us?
See, he should continue with SDFC Top 200, which is primarily a large cap fund. He should continue with ICICI Discovery Fund, and he should continue with Reliance Regular Saving Equity Fund. And in the gold fund, there is only one gold fund. He can continue with that.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, Ajay, that's the advice coming in for you. Your rebalancing has got to be done over a period of time, but you need to reduce the number of funds you have in your portfolio only because it's easier then to also review and monitor the performance of what you have. With that, it's a wrap on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection